Because the second chapter is absolutely about banking and the two branches or sides of banking. So there is commercial banks, and mostly this is traditionally regulated. So we can see that, okay, commercial banks are operating traditionally by collecting deposits on the short run and after that lending it out on the long run. And since the entire endeavor is financed by client money, to absorb the losses on lending, they had to use the capital of the bank. So this is where the owners of the banks are stepping in. So that's why we can say that any stupid people can create a bank, but the nature of the bank will be revealed during the next crisis. So when the original funders of the banks are not able to withstand the losses of the bank because the bank was managed stupidly, so they were not responsible, and that's why their non-performing loan ratio increases. But if they were careful enough, then they don't care about the next crisis because mostly they were not hit by a significant amount of losses on lending. And we can ask the question that why it's 8%, because in the case of Basel regulation, even in the first one they created this 8% rule that if you are providing a loan, then 8% of it must be secured. And okay, during Basel II and later on, they created subgroups for different risk categories. So they were saying that, okay, if you are providing loan to a small and medium enterprise or to a household, then 100% of this 8% must be secured as a capital reserve. But for example, if you are purchasing government bond, then this weight will be cut to 0. So you don't have to create capital reserve, which is a tricky thing because if you are in a state of public default, then yeah. That's why IMF provides usually packages for countries, not just to stabilize the bond market, but also to stabilize the banking system as well, because it can be intangible from going to one sovereign crisis to a banking crisis, or banking crisis to a sovereign crisis. So that's why they have to stabilize it. And also we know that not just equity, but also subordinated long-term debt instruments can be used. And in this case, the threshold is that you cannot withdraw this long-term debt for 20 years, but sometimes it's only 5 years. But the 5 years are considered as lower tiers, so it's in tier 3 or something like this in the legislation. So, but it's good to put long-term debt instead of equity, obviously, because in this case the owners will get some kind of revenues based on the interests which are paid after the long-term debt. So at least it's not considered that it's not depend on profitability on paper, what is happening with the dividends here. So that's why return on equity matters a lot in the case of the banking sector. And the other thing that they are doing this maturity transformation, which is really useful, and also the accumulation of the capital. So practically, that's why we have an industrial society, because otherwise it would be impossible to collect or accumulate enough savings to create any kind of big projects and investments into the corporate sector. But also, we can put here the securitization, which now it's not a new thing, so it exists for 2 decades already, and third decade already. When we are just, so the problem with the center maturity transformation, that okay, you are collecting this thing and lending it out, and after that you are just sitting on it as a bank. So you are not able to renew your asset side easily. But if you are able to sell it to someone, so you are creating this special purpose vehicle, which is the terminology for this entity. So the special purpose vehicle will buy your loans, and also they will add some government bonds to create a more diversified portfolio. And after that, they are creating different tranches. And first, the first tranche will be paid, then the second tranche will be paid. It usually, okay, it can have different versions, but the baseline scenario is that until the first tranche is not paid out, then the second tranche and the third tranche is just waiting. They just get interest revenues, but no capital at all. And once the first tranche is emptied out, then the second tranche is coming in. So practically we are selling 1, 2, 3 bonds in the background. And this is the cover of the enter acquisition. In real life, what is happening usually that, okay, the bank outsources this kind of loan, but also they are purchasing the bonds on their own, and after that they start to sell it. And this matters a lot because in many cases there was a huge panic about the securitized loans in 2007 than during 2008. But after that, market participants realized, and also the different authorities realized that most of the so-called toxic bonds were never in the market. So banks were not able to sell them because even during peaceful times nobody purchased these junk bonds. But during the crisis nobody had this information. So they were afraid of completely any kind of bonds because, oh my God, it's dangerous for me, and no, mostly banks were not able to get rid of them. And usually the last tranche is called as equity tranche because all the losses, what is realized on lending, will land here. So, yeah. So this is the originate and distribute scheme. And that's why if you would like to run a bank, then we can have two kind of incomes. We can have the net interest income, which is practically the difference between the asset side and the liability side, if these assets are paying interest, and also if we have to pay interest after all liabilities. And this is where the economics of scale is coming in. So practically banking is completely dependent on economics of scale. So if you want to increase your interest-related incomes, then you have to increase the balance sheet of the bank. So you have to be really active on lending or by purchasing different kind of bonds, government bonds, doesn't matter. In the case of non-interest income, these are the different commissions. So in this case, you are not forced to grow as much at the level of your balance sheets because in this case you are providing services for your clients, and yeah, so it's much more secure. And we can see that during the last 1.5 decades, so since or until the interest rates were really low or really close to zero, we can see that banks in Europe or in the US were not growing. Partially they were in trouble, but on the other hand, because mostly in a zero interest rate environment, you don't care about your net interest revenues because you are not realizing them at the previous level. So in this case, you are forced to non-interest incomes. To deal with them, to have some fees here and there, or some commissions here and there. And once you have interest rates on the market, then you can go back to the previous let's grow strategy back again. Yeah. Also, we should not forget about shadow banking because the book is completely forgot about the shadow banking, so that's why that's why I have to mention it, because shadow banking is responsible for nearly half of the lending on the market. So if companies or sometimes even banks need short-term loans, or sometimes even long-term loans, then they can go to the shadow banks. Practically what is happening here that these are the so-called, or one version of them, they are the money market funds. So money market funds are providing short-term loans to banks on the wholesale market. And also you can remember from international finance as well, when I was talking about the swap agreements between the different central banks. So shadow banks are, and also money market funds, are providing short-term loans in currency, in key currencies like US dollar, euro, or Japanese yen for foreign banks. And this is when this kind of market segment fails or they are not able to provide additional surplus funds for foreign banks, then this is when central banks had to step in and start to create swap lines to each other to create such ad hoc instruments. And the problem with shadow banking is that they are not regulated. So anyone can create a shadow bank because if you are able to issue a bond, then you can use this money up to purchase government bonds, and if someone needs some funding, then you can provide it them. So this is highly the gray area. It can be considered legal, just the problem is that you don't have any kind of Basel-like regulation here. So there is no safety at the level of insulating the loan, the asset side from the liability side in the balance sheet. In this case, bondholders are running all the lending risk. So, yep, this is when crisis can arise. And what you can do as a central bank, obviously you can start to purchase their bonds, and this is what happened practically in the case of the US Fed or in the case of the ECB under quantitative easing methods, when they were saying that, okay, let's purchase bonds which are backed by asset-backed securities, which are backed by mortgages. So something like this happens. But this is much more like a bailout. It's not just a stabilization or restoring the efficiency of the transmission mechanism. So okay, and other side of the banking system is the investment banks, which we know that in Europe this is a non-existent entity. And this was just created artificially in the US, and it was established between 1933 when the Glass-Steagall Act was created, and mostly it was ended during the 80s, but on paper by President Clinton in 1998, I think, or 7, whatever, when they were allowing commercial banks to have investment banks as a subsidiary. But before of them, already they had something like this, so that's why I'm quite passive or skeptic about it. But in Europe, commercial banks always had some kind of investment bank division, so it was never separated, and it was always considered as the universal banking. That okay, you have the commercial functions, you have the investment functions, but never as a separate thing. So, and since 2008, we can see that mostly investment banks were running out of capital in many cases, so they had to be bailed out or consolidated, and usually this consolidation was happening by merger and acquisition. So big commercial banks which were still robust enough, they were purchasing all the investment bank sector. So nowadays it's really hard to find any kind of independent investment bank on the market. Maybe Morgan Stanley, they are still not owned by other banks, but Merrill Lynch was also, I think Bank of America was buying Merrill Lynch. Also Lehman Brothers was trying to sell itself, just they were not fast enough, unfortunately. So they went down within a weekend. So, but otherwise, investment banks are really useful because they are providing unique services. So they are providing advisory services for mergers, for takeovers, also how to cut companies to pieces and put them back together. So everything what we did in the previous semester, and also they are important at the level of securities trading. So they can operate as a broker. So that's why they can be risky, and that's why they were separated in the US because. Otherwise, they are really important at the level of hedge. Just also since they are writing out or they are responsible for derivatives, if they are mishaps at the pricing of the derivative, then they are taking excessive risk. And this is what happened in the case of the long-term capital management. That okay, they were responsible for half of the option market globally. Just yeah, they messed up the equation, and heteroscedasticity killed them because they should increase their collaterals behind their positions by 100 million US dollars if global volatility increased by 1%. And sooner or later they were not able to take up loans anymore. So this is a really interesting story. Okay, and also they are supporting and helping those in debt. So if someone would like to issue some bonds, they are helping, or equity financing or convertible bonds, they can help with this as well. So yeah, and public offering can happen in two ways. Best efforts is the easy way, because in this case, yeah, we are creating some fundamental value, the estimated value, and if the IPO price is under this estimated value, who cares? We are ordering the incoming offerings, and after that we are serving them. But in the case of firm commitment, this is when you have to take a position. So I think, okay, it's not written in the book, but we can assume that in this case, maybe the commission behind this contract will be a bit higher to organize the IPO, because in this case they are fitted or connected to their fundamental values, so they had to take their position as well. And also private placement. So it can be also really lucrative to have universal banking. So if a commercial bank has its own investment bank and also has its own pension fund, no problem, has its own pension fund or insurance company, also they can sell the bonds or other assets to them. So practically you are feeding your own investors in the different branches with the client's bonds, which can put some additional risk into your balance sheet, but otherwise it's really lucrative, because also if they are buying this asset, then also you can get some revenues at the level of commissions, so it's lucrative. And of course, last thing in the interbanking system, so we have the different kind of risk: liquidity risk, solvency risk, and the prudence, so operational risk. So that's why we were dealing with all of these things, even with the operational risk during this semester. So that's why we had this